Hey there. So up till now, we've learned how to make the income statement, the balance sheet, and the cash flow statement. We will now start using these statements to make judgments about the company, about the current performance, and try and project the future performance in the review on financial analysis techniques, which is reading 28 of the CFA curriculum. So in the first part of this review, we'll start with an introduction to ratio analysis, study common sized statements, study the various ratios in detail, namely the activity, liquidity, solvency, and profitability ratios, and we'll wind up with a detailed example explaining the ratios. Now, analyzing the ratios that we will study in this review has many advantages, most notable of which include projecting future earnings of the company and future cash flows. That is, many of the expenses and balance sheet items, as we will study, will be a percentage of sales or the percentage of costs. So analyzing these ratios will help us predict the cash flows in the future and help us in our valuation and analysis. Ratios will also tell us about the firm's flexibility, that is, if the firm has sufficient cash flows and is generating sufficient revenues to capture new business opportunities as and when they arise, and if the firm will be able to deal with unexpected circumstances without much trouble. Ratios tell us about the state of the business and the performance of the company, which in turn is a reflection of how the management has been performing and can be used to benchmark and reward management's performance. Ratios tell us how the state of the firm has changed over the period and how is it relative to the industry and how has the industry changed over time. Finally, and very importantly, ratios help us compare the firm with the industry and other peer groups on various aspects of the business. Now, before we conclude anything significant from our analysis, we should be aware of the limitations of ratio analysis, so this section is very important. First of all, financial ratios are not useful when viewed in isolation. So they must be compared either to other firms or to the industry or to the company's own performance in history. So for example, if a company has a debt equity ratio of 2 times. Now before we conclude whether this ratio is high or low or in line, we must calculate the ratio for other companies in the industry, for the industry as a whole, and then see. So for example, it may be an industry where cash flows are relatively stable and businesses work with a high debt equity ratio so as to maximize the ROE. Bottom line being that before you conclude high or low, you must compare. Ratios have no meaning in isolation. We'll keep repeating this throughout the review, and it's something that you should always be aware of. Comparability, however, becomes difficult as different companies follow different accounting treatments. So please make sure that you're comparing apples to apples and you make the necessary adjustments if the two firms are following different accounting conventions. Thirdly, it is difficult to find comparables for conglomerates or companies that operate in multiple industries. So if it's a plain vanilla steel business, for example, company A, then it'll be relatively easy for me to find company B, company C that are in the steel business. However, if company A has a steel business, a textile business, and a real estate business, then to find a comparable company exactly to company A, that is another company that is exactly in these 3 businesses in the same proportion, is going to be relatively difficult. So for conglomerates, finding comparables is a relatively tougher job. Now, one set of ratios will never give me the complete picture. So conclusions cannot be made from viewing just one set of ratios. All ratios must be viewed relative to one another before I can make an overall judgment about the company. And last but not the least, determining the target or the comparison value for a ratio. So for example, let's assume the debt equity ratio is what we are trying to compare or make a judgment about. So oftentimes, getting an exact value for the debt equity ratio as acceptable will be difficult. So we would work with some range of acceptable values. So we'll say that between 1.75 to 2.25 is an acceptable debt equity ratio. Below this is too low or above this is too high, so on and so forth. So we'll now start off with calculating and interpreting the various ratios. We begin with vertical common sized income statement ratios, which is basically each income statement account divided by the total revenue or the total sales. So these ratios give us an indication of the profitability of the business. As we'll see in the example that for 2012, revenues as a percentage of the revenue would be 100%. The cost of goods sold, which we studied earlier, are mainly raw material costs, are 55.5% of the total sales. So whatever we earn, more than half of it goes away in raw material expenses. What is left is called gross profit, and gross profit divided by the total sales would be called as gross profit margin. That is 44.45%. Other expenses, that is selling, general and administrative, depreciation, amortization, take away another about 15% and we get an operating income of 28.98% of the total sales. This is known as operating income margin. Similarly, interest as a percentage of sales, taxes as a percentage of sales give me the net income as a percentage of sales, that is 22.1%. Similar calculation has been done for each of the preceding years. So the common sized income statement shows that even though the company's gross profit margin has been coming down, you see the raw material costs as a percentage of sales have been going up over the past couple of years. Company's operating margin and net margin has pretty much been intact, rather marginally improved because of good control over other costs. So selling, general and administrative costs, as we see in this example, has come down significantly, which is what has resulted in good margins sustaining over the, like with every ratio, as we'll see, we have to compare these margins with the industry level and with other companies before we can make any general judgment about the company or about the margins. Vertical common sized balance sheet ratio similarly is each balance sheet account divided by the total assets, or we can say the total liabilities plus shareholders' equity. That's the basic accounting equation. So we see for the year 2012, cash and equivalents are about 0.25% of the total assets, so not much cash that the company is holding. Receivables are about 5%, 8% inventory. Current assets are about 14% of the total assets. Gross fixed assets is 40%, net fixed assets is 32.8% of the total assets, and a big chunk of the total assets are other long-term assets, possibly goodwill or other intangible assets, as we studied in the review on the balance sheet. We can figure that this company has a substantial chunk in these other long-term assets, and we may want to probe deeper to understand what is the value and contribution from these assets. So we see that the balance sheet has remained pretty stable over time. Net fixed assets as a percentage of the total assets have been increasing. Cash has remained constant. So have been most of the other assets. We can likewise check the liabilities side of the balance sheet. So we find that accounts payable and other short-term liabilities or current liabilities are about 14% of the total liabilities. Long-term debt and other long-term liabilities included give the total liabilities at 63%, and the remaining part of the business, that is about 37%, has been funded by common and preferred equity. We can do the calculations similarly for all previous years, and we find that equity as a percentage of the total balance sheet or the total liabilities has been going up, and other liabilities have been coming down. In horizontal common size statements, we fix any year as a base year. So for example, in this case, we fix 2010 as the base year. So all values for 2010 would be assumed to be 1, and subsequent years would be calculated relative to the year 2010. So inventory, for example, was 1.75 times the inventory that was there in 2010, and was in 2012 was 2.12 times the inventory in 2010. Likewise, cash has gone down a little as compared to 2010. Long-term debt has doubled over the 2-year period. Property, plant and equipment net of depreciation is 1.6 times the number in 2010. So we see that the company has become bigger. There's more inventory, more debt, more plant and machinery, and it's not keeping much cash, so it's well utilizing its cash in buying assets or inventory is what it looks like. Again, guys, for all ratios, we have to compare them with the industry, with other companies before we can make a clear judgment about whether it is good or bad. Now, activity ratios tell us how well a firm utilizes the various current and fixed assets that it has. So the first activity ratio that we'll study is called the receivables turnover, calculated as the annual sales upon the average receivables. Please note that this ratio is called as an impure ratio since it is an income statement item divided by a balance sheet item. So whenever we have impure ratios, that is an income statement on a balance sheet, the balance sheet item would normally be an average of the last 2 years, whereas the annual sales or the income statement item will be for the preceding years. So the receivables turnover is defined as the annual sales upon the average receivables. Let's assume, for example, that the annual sales were $100 and the average receivables in the period were about $50, or the receivables turnover ratio is equal to 2. We'll understand the interpretation of the receivables turnover better after calculating the days of sale outstanding. So this is calculated as 365 upon the receivables turnover. In our example, it will be 365 divided by 2. That is 182.5, or about 6 months. Now, why do receivables arise? It's because of credit sales or sales that have been delivered but will be paid over a period of time. If of a sale of $100, $50 is still outstanding, this implies that on an average, my customer is paying me after 6 months or 182 days. If we assume that the sales are made uniformly throughout the year, that is over the period of 365 days, I'm making my sales, then we can conclude from the above example that sales made during the first few days have all been collected in the form of cash. So the sale made at the end of the first day would have come by now. Similarly, after the second or the third day, all sales made in the first half on an average have been received by me because half the money has been collected. $50 out of the 100 have been collected and only 50 are outstanding. What we can assume hence is that sales made in the second half of the year, since half the sales have not come and we're assuming that sales are uniformly distributed, sales made in the second half are going to come in the coming 6 months or the next 6 months after the balance sheet date. So I'm making the balance sheet as of the 365th day or as of the end of the year, and only half the sales have come in the form of cash. So this implies that on an average, my customer is paying me after the days of sales outstanding, in this case 6 months. Similarly, the inventory turnover ratio is calculated as the cost of goods sold upon the average inventory. Let's assume that this year the company made $100 cost of goods sold and had an average inventory in its godown worth $50, such that the inventory turnover ratio would come out to be equal to 2. We will again understand the interpretation better after calculating the next ratio, that is the days of inventory on hand, given as 365 upon the inventory turnover. Similar calculation as the days of receivables. So in this case, it comes out to be 365 upon 2. That is approximately about 6 months. Now, for selling $100 worth of material, I still choose to keep $50 worth of inventory in my godowns or as stock in my stores. So this implies that even if raw material supplies stop from today, I will still be able to service 6 months of sales because 6 months worth of raw materials I keep in stock. The payables turnover similarly is calculated as the purchases made in the year upon the average trade payables. So let's take a similar example. If we had $100 worth of purchases that we did, that means we were supposed to pay $100. And if we have about $50 worth of payables, that means we've paid only about half the money. half the money is still sitting on our balance sheet as a payable. So the payables turnover ratio in this case would be 2. And we can calculate the days of payables as 365 upon the payables turnover ratio. That will be 365 upon 2, which is again about 6 months. So like the other ratios, this ratio implies that on an average, we are paying our suppliers after a period of 6 months. Other activity ratios deal with fixed assets. So the total asset turnover would be the revenue upon the average total assets. So if I have $100 worth of assets and I make a revenue in the year worth $100, then the total asset turnover is 1 times. Fixed asset turnover correspondingly is given as revenue upon average net fixed assets. So how much sales are we doing for the amount of fixed assets that we have employed? Working capital turnover would be the revenue upon the average working capital, which is the current assets minus the current liabilities. Tells us that what revenue are we making for the investment in working capital that needs to be done. Now we'll repeat once again that each of these ratios must be compared before we make any conclusion. So total asset turnover, if it's too high, is also bad because it may indicate that we are sweating our assets too much. If it is too low, it possibly indicates inefficient use of the asset. Again, we need to compare it with the industry and with other companies before we make any conclusion. Similarly, with all the other ratios, the inventory turnover, receivables turnover, payables turnover, too high or too low of any ratio is bad. If you're keeping too much inventory, it entails higher storage costs. If we are keeping too little inventory, we may not be able to service a sudden spurt in sales. So for any ratio, guys, that we will study, remember that it must be compared, and too high or too low can both be dangerous under different circumstances. Liquidity ratios tell us about the short-term funding position of the company. Does it have enough cash to meet its short-term liabilities? The first ratio in this regard is called the current ratio, which is calculated as the current assets divided by the current liabilities. So current assets include cash, marketable securities, accounts receivable, inventories, etc. Current liabilities are short-term notes payable or current portion of the long-term debt, accounts payable, etc. So if this ratio is greater than 1, then it implies that the firm has enough current assets in order to meet its current liabilities. If it is less than 1, that means the firm will have to find other sources of funding in order to meet its short-term liabilities or current liabilities. Please note, like any other ratio, too high a ratio implies that the firm has a lot of current assets. So it has a lot of cash, etc., which it probably is not utilizing very well. And too low a ratio would indicate that the firm has short-term liquidity concerns or funding concerns. The quick ratio is a more conservative current ratio, wherein we assume that inventory is not current. So we exclude inventory from the current assets calculation, and the ratio is calculated as the cash plus marketable securities plus the accounts receivables upon current liabilities. So it gives us the same information as the current ratio, but uses only the more liquid assets. In the cash ratio, we exclude accounts receivables also. So we only take the liquid cash and marketable securities as current assets, and we want to check that do we have enough cash and equivalents to meet our current liabilities. So it's even more conservative than the quick ratio. The defensive interval tells us if the firm has enough liquid assets to meet the daily expenditures, calculated as the cash plus marketable securities plus receivables upon the average daily expenditures. The next calculation is a very important one, called as the cash conversion cycle, which tells us as to how many days of working capital funding does the business need. calculated as the days of sales outstanding plus the days of inventory minus the number of days of payables. Please note that the first two terms of this equation are collectively known as the operating cycle that we studied in the balance sheet, representing that how many days do I keep my inventory before I'm able to sell it. So let's say this is 50 days. And after selling the inventory, after approximately how many days do I receive the cash? So let's say the days of sales outstanding are another 50 days. So roughly about 100 days of inventory funding is what I would need from banks or from different sources so as to create the product and deliver it to my customer. About 100 days later, the customer is going to pay me the money and I can repay the banks. If I'm purchasing material on credit, however, that is, I'm paying my suppliers after some delay, then the cash conversion cycle is reduced to the extent of the number of days of payables. So let's say I pay my suppliers after 25 days of purchasing the product. So the cash conversion cycle would be 75 days, or I need short-term funding for 75 days of operations, after which I will collect the cash from my customer. So cash conversion cycle can also be thought of as how long does it take to procure the raw material, create the product, sell it, and collect the cash. Shorter cash conversion cycles means shorter working capital funding requirements, but may indicate that I'm too strict and I'm not giving any credit to my customer, which may not be in the best interest of the business. Too long a cash conversion cycle means that there are possibilities of bad debts, or I may require excess funding to meet my working capital requirements. Solvency ratios tell us about the long-term funding position of the company. So does the company has enough assets and equity to meet its long-term obligations? So the first ratio that we'll study is called debt to equity, which is calculated as the total debt, short-term plus long-term, upon the total shareholders' equity. This will include preferred equity, if any. Please note that debt has a fixed maturity and needs to be paid back by that date, whereas there is no fixed maturity for equity. So more debt on the capital structure may imply higher risk as that debt becomes due and whether or not we have sufficient cash to make that payment. Whereas more equity in the capital structure means relatively lesser risk. Similarly, the debt to total capital ratio will be calculated as the total debt upon the total debt plus total shareholders' equity. Please note that all of these ratios give us the same broad indication, or they all have the same implication, but you have to remember the different formulas. Debt to total capital would be the debt upon debt plus equity. Debt to assets similarly will be total debt upon total assets. These would also include now the current assets along with the long-term assets. Very important ratio called financial leverage, or simply leverage, is the total assets upon the total equity. Please note it's a pure ratio. It's a balance sheet item divided by a balance sheet item. So normally we could simply use the end of period values. In some questions, however, you may be asked to use the average to compute the ratio. Make sure that you're uniformly applying the formula. So if you're taking the average for one company, then make sure you take the average for the other company as well. Otherwise, just taking the end of period values will also do for solvency ratios. Interest coverage tells us if the company is making enough earnings to meet its interest payments. So after earnings before interest and tax, we are supposed to pay interest. So is the earnings before interest and taxes sufficient to make our interest payments? If not, then the company may have to borrow more or may have problem funding its interest costs. Similarly, fixed charge coverage ratio will include all fixed charges, that is normally interest payments plus any lease rentals that the company has to make. So it will be the earnings before any fixed charges upon the fixed charges. So these are the earnings that are available to make my interest and lease payments. And if we have sufficient earnings, then we'll be able to service these payments, else we may depend on external funding. Profitability ratios tell us how profitable the business is, or how much value are we adding to the raw materials in the products that we are creating. So we calculate various margins when we compute these ratios. Let's look at the broad structure of the income statement again before we calculate these ratios. So net sales minus the variable expenses. These are primarily raw material costs and other directly attributable costs for the products that we are manufacturing. So net sales minus the cost of goods sold gives us gross profit. So this is only the variable cost. The gross profit divided by the net sales gives us the gross profit margin, or called the gross margin. So higher gross profit margin means that I'm able to significantly add value to the raw materials that I'm producing, and lower gross profit margins may indicate high competition in the industry or a commoditized product for which customers are not willing to pay much higher than the cost of goods sold. Minus the operating expenses, these include sale, general and administrative expenses, depreciation, any lease rentals, etc. that are required to be paid in the course of the business. So the difference of the gross profit and the operating expenses gives me the earnings before interest and tax, also known as operating profit or operating income. This divided by the net sales will gives me the operating profit margin, or the operating margin of the business. Minus interest gives me earnings before tax and the PBT margin once I divide it by the net sales. Minus taxes will give me the earnings after tax, or the income from continuing operations. Any extraordinary items are reported below the line adjusted for tax, giving me the net income, and net income upon the net sales gives me the net income margin, or the net profit margin. The net profit margin is net income upon revenue, as we studied. Too high a margin may not be sustainable. It may be a good thing, however, please check whether it's a one-off high net income or is it a sustainably high margin. And if the margin is too low, it may indicate that the business is not generating sufficient returns. You can revise the definitions before we go ahead. The gross profit margin is gross profit upon the revenue. Operating profit margin is operating income upon the revenue. Pre-tax margin, likewise, as we discussed. Please note that the same conditions for too high and too low that were applicable to the net margin will apply to all these margins. So while high margins indicate high return, we may want to check the sustainability of those high margins before we project future earnings and future margins. Another category of profitability ratios calculates return on the investments that we have made. So the first ratio is called return on assets, which is calculated as net income upon average total assets. So for the total assets that the business has employed, what is the net profit that the business is generating? Now looking at ROA in this fashion can be a little misleading, as two assets which are exactly the same may be generating different net income, not because the asset is any different, but just because of the way the asset has been funded. That is, if interest cost is very high in one case, then the net income can be misleading. So net income is for equity holders and it should not be compared to the total asset. And let's understand an example. So let's assume that company A has asset worth $100 and has been funded completely by equity of $100. Company B is in the same business, has the same asset worth $100, but he chose to fund it partly by equity and partly by debt. Let's assume that the interest on this debt is 20%. Now, the sales for company A and the sales for company B will both be the same because the asset is the same, it's operating the same way, the markets, the business, everything is the same. So A does $100 worth of sales and so does B. The operating expenses for A are $50 and so will be the operating expenses for B. However, company B also has an interest expense because of the debt that he has taken. So the interest cost for company B is another $10, giving a net profit of $40 in case of company B, and $50 in the case of company A. Please note we're ignoring tax here. So if we compute the return on assets, then for company B, the ROA will be the net income upon the total assets, that is 40%. And for company A, the ROA will be net income upon the total assets, that is 50%. So the ROA for company A is higher, or it is looking like company A has better assets than company B. This is not the case. This is actually a problem with the way we are calculating the ratio. We should not compare the average total assets to the net income, because net income belongs to the equity holders and the return that the asset generates belongs both to the debt holders as well as equity holders. So a better way of calculating the return on assets is net income plus the interest into 1 minus the tax rate upon the average total assets. The reason we do this is because interest expense is a funding choice and has no bearing on the performance of the asset. So if we again compare the ROAs of the two companies using the revised formula, then the ROA for company B would now be 40 plus the interest, that is $10, upon the total assets, that is $100, that is 50%. And so will be the ROA for company A. So this will give us the true picture that actually both assets are the same and both assets are giving a return of 50%. Now please remember, as we have studied many times before, that interest is a tax deductible expense. So no interest means no associated tax benefit as well. So if you add back the interest expense, you'll have to subtract the tax shield that interest was giving. Hence the net effect would be interest into 1 minus the tax rate. So the return on assets, if nothing is specified, please use the second formula, not the first one. That is the net income plus interest into 1 minus tax upon the average total asset. If the question asks to compute the operating return on assets, then operating return is defined as the operating income upon the average total assets, that is the EBIT upon the average total assets. So you'll have to remember these slight differences between the various ratios, and it's going to get complicated as you learn more and more ratios. So return on total capital is another profitability ratio defined as the EBIT upon the average total capital. It's an impure ratio, so income statement item from the previous year, balance sheet item as an average of the last 2 years. So total capital is the total equity plus the total debt, short-term as well as long-term, as we've studied. Return on equity is a very important ratio. We'll be talking about it in many other reviews as well. Defined as the net income in the previous year upon the average total equity. Sometimes we use the beginning equity as well, or the beginning book value, as we'll see in other reviews. The return on common equity, as the name suggests, would be what is available for common shareholders, that is net income minus preferred dividends upon the average common equity. That is the net income available to common shareholders divided by the average common equity. So we'll do an example and understand these concepts and ratios better. So using the company information provided below, calculate the current year ratios, discuss how these ratios compare with the company's performance last year and with the industry's performance. So we're given a sample balance sheet, cash, receivables, inventory, fixed assets, the liabilities, and we're also provided with the income statement. The question asks us to compute the following ratios using the data provided in the previous slide and compare them with the last year numbers as well as that of the industry. So we'll dive right into it. The current ratio is defined as the current assets, that is cash, marketable securities, accounts receivable, upon the current liabilities. So let's calculate. Please note that it's a pure ratio, a balance sheet item divided by another balance sheet item. So we can just use the end of period values. We don't need to take an average. The current assets is given to be $675 and the current liabilities are $495. So the current assets upon the current liabilities will be calculated as 1.36 times. So the ratio is lower than last year, but still higher than the industry average current ratio. And the quick ratio is the cash plus marketable securities plus the accounts receivable upon the current liabilities. So we'll again go on the asset side and now ignore inventories. So the cash plus marketable securities plus receivables comes out to be $225, and the liabilities remain the same, that is $495. So the quick ratio will be calculated as 225 upon 495, that is 0.45. So we see that the quick ratio has also come down as compared to last year, but is still in line with the industry average. So nothing big to really worry about. The days of sales outstanding is 365 upon the accounts receivables turnover, or the receivables turnover, which in turn is calculated as the sales divided by the average accounts receivable. Now this is an impure ratio, so we'll take the average of the balance sheet item. The sales are given to be 4,800 in the question, and the accounts receivable were $100 at the end of the year and $220 at the beginning of the year. So the average can be calculated as $160. So the receivables turnover will be calculated as 4,800 divided by 160, that is 30 times, and the days of sales outstanding can be calculated as 365 divided by 30, that is approximately 12.1 times. So there has been some improvement in our receivables days, that is creditors have started paying us early, they have come down, but we're still slightly above the industry on this metric. Inventory turnover similarly can be calculated as the cost of goods sold upon the average inventory. So the cost of goods sold from the income statement is $4,000, and the average inventory is 450 plus 350 by 2, that is $400. So inventory turnover can be calculated as 4,000 divided by 400, that is equal to 10 times. So it's deteriorated from last year and is slightly below the industry average. That is, there is scope for us to turn our inventory faster or keep lesser inventory for the sales that we are doing. Likewise, the total assets turnover, working capital turnover, gross profit margin, net profit margin can easily be calculated from the formula that we studied earlier and can be compared with the industry as well as the company's metric last year. We'll now move on to computing the return on total capital, and this is defined as the EBIT upon the total capital. So please note it's again an impure ratio, so the balance sheet item will be an average and the income statement item coming from the previous year. So total capital implies total debt, both long-term and short-term, plus the total equity. So the EBIT from the income statement is given to be $300, and total capital can be calculated from the liability side, that is the total debt plus the total equity. The total debt would be the short-term debt plus the current portion of the long-term debt plus the long-term debt. So the end of the period total debt would be 210 plus 175 plus 645. That comes out to be equal to 1030. We'll add the total equity at the end of the year, that is 1970, to get to our total capital at the end of the year as $3,000. We can similarly do the calculation for the beginning of the period. That will be 205 plus 75 plus 565, which comes out to be equal to $845. And we add to that the total equity at the beginning of the period, that is $1,340, giving a total capital at the beginning of the period as $2,185. So we can compute the average total capital as $2,592.5 and use it to calculate the return on total capital as 300 upon 2,592.5, that is approximately 11.57%. So we see that return on total capital has significantly deteriorated. Probably the new investments that we have made have not yet shown us the returns that we envisaged. So this ratio is now significantly below the industry as well as last year. You can similarly calculate the return on common equity, the debt to equity, the interest coverage. Interest coverage is defined as EBIT upon the interest. Again, it's a pure ratio, so just take the last year's values and verify your answers as are there in the coming slides. So please do the calculations yourself before you move ahead. Current ratio, quick ratio, days of sales outstanding, inventory turnover, total asset turnover, working capital turnover, gross profit margin, net profit margin, return on total capital as we calculated, the return on common equity, debt to equity ratio. Again, it's a pure ratio, so just use the end of period values. No need to take an average. And the interest coverage, that is EBIT upon the interest payment. So that was about the core review on ratio analysis. We'll study some more ratios in the next part of financial analysis techniques. Thank you. See you next time.